I made just one purchase, only $47. That same night, my credit score dropped by 80 points. At first, I refused to believe it. I checked the account again, but the numbers didn't change. In this video, I'll explain what I learned that night. I'll show you the hidden mechanics of the credit system and how to avoid this trap. A credit score is not simply about paying your debts on time. The system is far more complex than most people realize. There are 5 core components to your score. One of them is more widely misunderstood than all the others combined. That component is your credit utilization ratio. It makes up a full 30% of your entire credit score. Imagine your credit limit is $1,000. In the middle of the month, you spend $500. At the end of the month, you pay the entire balance. The account is at zero and you think everything is fine. But the bank sees a completely different number. It doesn't record what you paid, it records your balance on the statement date. If your balance was $500 on that date, the system logs your utilization as 50%. Credit bureaus treat that as a high-risk signal. The ideal utilization ratio should be below 30%. For the best results, keep it below 10%. That means on a $1,000 limit, your statement date balance should be no more than $100 to $300. Most people have no idea this distinction exists. The problem doesn't stop at one card. Credit bureaus look at your overall utilization across all cards. If one card is heavily loaded, it drags down your entire credit profile. The system evaluates each card individually and all of them collectively. A high utilization ratio causes direct financial damage. When you apply for a mortgage, even a 1% rate difference means thousands of dollars over decades. The same applies to auto loans. A lower score means a higher interest rate. Some employers in the finance sector also check credit reports of applicants. Your high utilization can affect your job opportunities as well. Your credit score now touches many areas of your life, not just finance. Now let's get to the key question. Why does this problem persist for months? Because utilization is recalculated every month, but past damage leaves a mark in your history. Bureau algorithms look at trends over recent months, not just the current one. Even if you fix things today, recovery is slow. The first solution step is learning your statement date. Find out exactly when your bank pulls your balance each month. Make an extra payment 3 to 5 days before that date. This brings your balance down before the system records it. The second step is making payments twice a month. A small payment on the 15th and the rest at month end keeps your balance consistently low. The third step is requesting a credit limit increase via soft inquiry. As your limit grows, your utilization drops automatically with the same spending. The fourth step is never closing old credit cards. When you close a card, your total available credit shrinks and utilization rises automatically. The fifth step is spreading spending across multiple cards. Loading everything onto one card drives that card's ratio through the roof. The sixth step is setting up automatic payments for the full balance. This eliminates late payment risk and keeps your balance at zero. The seventh step is monitoring your credit report regularly. You can get a free report from Equifax, Experian, and TransUnion once per year. The eighth step is using the authorized user strategy. A family member with a strong card history can transfer that positive history to your report. The ninth step is considering credit builder loans if your score is still low. Some banks and credit unions offer these at low interest rates. The 10th step is being patient after making changes. After a payment, it typically takes 30 to 45 days for bureaus to update your score. Now, the most asked question, how long does full recovery take? With consistent behavior, expect 2 to 3 months for improvement and up to a year for full recovery. The top mistakes to avoid are closing cards and making only minimum payments. These 2 habits alone can suppress your score for years. Never apply for multiple credit products in a short time period. Each hard inquiry drops your score by 5 to 10 points and stays for 2 years. According to FICO data, people with scores above 750 average below 7% utilization. Those below 650 average close to 50%, and that is not a coincidence. A utilization ratio of 0 is also not ideal. Use 1 to 9% of your limit and pay it on time every single month. Your credit score doesn't measure how much debt you have. It measures how much of your available credit you are using at any given time. Learn your statement date, keep your balance low, and stay consistent. Hit the like button if this helped and subscribe for the next video on raising your credit limit the right way.